Good morning, ladies and gents, and welcome to the October 2025 installment of the Blackfinch 10-minute market forecast. Thank you for joining us today. My name's Jordan Kent, distribution and sales exec for Blackfinch Asset Management, and my co-host today is Mr. Josh Clayton, listed product specialist for Blackfinch Group. It's been a real delight to see so many familiar faces join us month on month, and also see others that are new to this webinar. So for those joining us for their first time today, we use this webinar to provide you with what is, in our view, some of the most important headlines across the globe impacting markets, arming you with the detail you need to help your clients to achieve their financial objectives. If you have any questions through today's webinar, then please do ask it in the Q&A box at the bottom of your screens, and we'll come back to you once today's session is concluded. Alternatively, I'll be providing you with our contact details to reach us directly at the end of the session. Before I give us an outline on this morning's content, it is important for me to note the detail we cover for you today is intended for the financial professional community only, and as such should not be interpreted or taken as financial advice. So today, we've got three big themes to explore. First, we turn to Japan. Now, we've seen business sentiment remain firm, even as global trade tensions and US reciprocal tariffs dominate headlines. So here, we'll look to explore what this means for the Japanese economy as well as their equity market. Next, we'll shift focus to the US, where political gridlock has resulted in a government shutdown. Now, whilst history suggests these events are often short-lived, we'll explore if this instance were to drag on long enough, whether it could dent growth, unsettle employment, and perhaps even influence the Federal Reserve's next move on interest rates. And finally, we'll explore one of the most powerful drivers of markets today, AI-related investment. Spending on infrastructure and innovation continues to surge, fueling optimism and extending the US equity bull run. So we'll look to understand what effect it's already had on markets and what the next chapter may well be in the story. So stepping back and looking at these three themes together, the key questions become clear. How attractive really is the Japanese equity market today? Will the latest government shutdown in the US prove to be just political noise, or could it have real consequences for growth in markets? And finally, what's next for the ongoing AI spending frenzy, and how is this going to impact equity markets? So with today's scene set, I'll hand over to Josh, who will take us through each of these themes in detail. Good morning, Josh.
Good morning, Jordan. Good morning, everyone. Thank you for myself for joining. Now, as Jordan's already alluded to, it really has been a bit of a buoyant time in markets, so we've got a lot to cover. So if we go on to the next slide and get straight into the first theme, I thought we'd start in Japan today, and putting aside the PM election over the weekend and the market rally after it, one of the key events we've had recently is the Bank of Japan's Tankan survey. And for those less familiar, this is a quarterly business sentiment survey conducted directly with thousands of Japanese companies across your manufacturing, your services. And it's one of the most closely watched indicators in Japan because it gives that direct read across on how businesses themselves are feeling about current conditions and future prospects, not just what markets are pricing in. And this latest release showed business sentiments improved again, particularly among large manufacturers, which is encouraging given the global backdrop. And despite all of these headlines around slowing global trade, the risk of higher US tariffs, Japanese firms remain confident. And that suggests underlying domestic demand and structural tailwinds are still strong. And in fact, the survey is often viewed as a leading signal for corporate investment and hiring. So this sustained trend matters for that forward growth. And if we use the chart on the screen here, this represents the survey. It's a diffusion index that takes those businesses that express conditions are favorable, and it takes away from those that say unfavorable. So your zero marks stagnation, anything above reflects that positivity. And we really have seen corporate Japan stay firmly in positive territory in recent years. It does really feel like that trauma from the 80s and many zombie companies have become a thing of the past. And the government and the central bank are moving toward policy normalization, where they act like many other developed economies. And it's important to note that even with Trump's reciprocal tariffs pressuring Japan, sentiment hasn't budged. It hasn't shifted. Over 25, it's still positive. So this supports our view that Japanese companies, they're navigating external pressures far better than expected. It tells us that confidence it isn't only holding up, but it's being translated into investment in output. And I guess what that means for investors, it reinforces our case for Japanese equities. Firstly, the valuations in Japan are attractive compared to other developed markets like the US. That can give a bit of a cushion. Secondly, we've seen meaningful corporate reforms. There's better governance, stronger shareholder returns, increasing share buybacks. And then thirdly, domestic factors. They've got healthy wage growth, resilient consumer spending, and that's all adding to this more positive outlook. So while headlines around tariffs might grab attention, it's important that it hasn't derailed sentiment on the ground. Businesses are optimistic, reforms are unlocking value, and we think that's a very attractive opportunity for long-term investors in Japan. Now then, of course, we have to turn our attention to the US once again, and this comes twofold for the webinar. So the first theme for us to cover is a near-term headwind for the market. And as many of you have seen in the news, the US government shut down after a deadlocked Congress failed to reach a deal on funding. A very quick explanation. So the US federal government operates on an annual budget, which Congress must pass, then the president must stamp and sign. So if they fail to agree on funding bills by that deadline, so the first, many governments' operations will literally run out of legal authority to spend money. And then when that happens, the government shuts down all non-essential services until a deal's struck. And the key impacted persons are normally federal workers in the US that are furloughed from that halt in activity. So in our view, the likelihood of this being prolonged is unlikely. This is because the economic costs of a government shutdown are normally minimal unless they last several weeks. And that's, in our view, quite unlikely because of political optics, especially since it's Trump's midterm elections in 2026. He's not going to want slowing economic growth in the run-up to it. Never say never, of course, but if we look down each of the fiscal years when this event happens on the left-hand side chart, we can see these last days before a resolution. So the economic impact is likely to be minimal, but it does lend some downside risk to real GDP growth in Q4. So to warrant a change to the forecast, the shutdown would need to be longer than normal to leave that mark on the economy. And that is what the right-hand chart is showing. So this is just a scenario where the shutdown lasts for 3 months, so Q4, which is unlikely, but again, useful worst-case scenario. The shutdown leads to a permanent decline in GDP relative to the October baseline because lost hours during the shutdown aren't really fully recouped. So what this tells us is the length of the shutdown and furloughed workers matters. A prolonged shutdown can actually feed into the US unemployment rate. The Oxford Economics team approximately would quote about a 0.5% add-on, which is 900,000 workers. And if you've watched our previous webinars, this figure is really important for the Fed's employment mandate. So what does this mean for investors? If the shutdown goes on for long enough, we could see the Federal Reserve begrudgingly bring forward another interest rate cut from potentially December. The Federal Reserve emphasized the September move was a bit of an insurance cut, and a shutdown would likely leave the central bank in a bit of a fog about the labour market. And that fuels support for an October cut, rather than them risking falling behind in 26, having to catch up on cuts later. This would again be supportive for US equities, and the Federal Reserve interest rate decision this October is going to be even more important for markets. So finally, part 2 on the US for this webinar. This is a theme I've been talking to our clients about quite regularly recently. As we know, the US market has just been on a strong run for some time now. Sadly for UK investors, currency impacts have somewhat diminished returns if you're buying the US market in sterling terms. But generally, investors were believing a market correction was due, and this was largely expected to be a recession. But as time has passed, the consensus has shifted to where the US economy slows down, but instead have a soft landing, meaning no recession. And one of the key factors from this was a boost from AI-related investment in equipment, in structures, and it doesn't really seem to be tapering off anytime soon. And this investment was supporting the economy as it digested the effects of these tariff impacts, the policy uncertainty. So the economy is reaping the benefits of this AI-related investment, which has then offset some of the weaknesses elsewhere. And this leaves many investors being very bullish on the US equity market at the moment. And the train doesn't look like it's going to run out of steam anytime soon. And it's this mega trend combined with the one big beautiful bill that has a lot of economists forecasting one of the strongest levels of economic growth in the G7 over the near term. And investors believe, some investors believe that earnings growth and valuation is going to keep the momentum. So to bring the chart in, the AI adoption rates for businesses is just going up. There's plenty of room to rise, particularly outside of tech and financial services. And many think this is going to underpin demand for equipment and software. And of note were some of the largest tech companies in the world, and that's on the chart here. Alphabet, Amazon, Meta, Microsoft. They've all increased their spending plans next year. And this is what the chart is showing. It's that year and the following 4 years after that. And again, this looks as though it's feeding into economic growth, and this keeps this AI craze, this trend rolling forward. Now, of course, there are tail risks. There's a lot that could affect this. There could be a regulatory crackdown, like new data privacy rules being made. There's big environmental impacts because it just requires so much power to operate. And there's also a lack of like measurable ROI, a return on investment. There are a lot of AI pilots that don't quite scale upward or deliver positive financial returns. So certainly lots of risks at the moment and a lot of sensitivity in the US equity market. But whilst this momentum's going, it's business as usual, especially if we get an additional rate cut from the Federal Reserve. So to summarize what we've covered, this Japanese survey is one of many indicators that shows Japanese sentiments very robust, particularly across manufacturing, even against the backdrop of slowing global trade. I think importantly, the noise around US tariffs hasn't derailed optimism, and this resilience creates a strong case for Japanese equities. You're improving conditions with attractive long-term value on offer. And we do very much remain exposed to that market, and more so than some of our peers at the moment. And turning to the US, there are near-term risks, as I've said, that could hit growth if prolonged. But we've got to remember the US economy has held up well. There's healthy spending and investment. So while shutdown headlines can unsettle markets, the bigger picture points to this AI craze that I've mentioned. And that's the final point. AI and corporate investment in new equipment, structures, they're powerful drivers of US growth. It's a big part as to why the US has led equity markets recently. But it's also important, as we've discussed in the webinar, to highlight that the story isn't just the US alone. There are global opportunities that are emerging in Japan, in Europe, emerging markets and beyond. And we've said this before on the webinar, but it means that US exceptionalism isn't the only game in town anymore. There's a lot of opportunity at the moment. But yeah, thank you. That's everything from me. Jordan, over to you.
Thank you very much, Josh. And thank you everyone for choosing to spend your morning with us today. As promised, if you do have any questions on what we've covered today, or perhaps you'd like to hear our thoughts on aspects that weren't covered, do reach out to Josh and I with the details on screen now, as we'll be on hand to help. Otherwise, that does conclude today's session, which we hope you found useful. And if you think any colleagues and peers would benefit, then be our guest and extend an invitation out to them to join us for November's instalment, which will take place on Tuesday the 4th at the same time of 8:50 a.m. What's left for me to do is to wish you on behalf of all of us here at Blackfinch Group a present day, and we look forward to seeing you again very soon. Bye for now.